Welcome to Creating Wealth with Jason Hartman. During this program, Jason is going to tell you some really exciting things that you probably haven't thought of before, and a new slant on investing. Fresh new approaches to America's best investment that will enable you to create more wealth and happiness than you ever thought possible. Jason is a genuine, self-made multimillionaire who not only talks the talk, but walks the walk. He's been a successful investor for 20 years and currently owns properties in 11 states and 17 cities. This program will help you follow in Jason's footsteps on the road to financial freedom. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to the Creating Wealth Show. This is episode number 181, and this is your host, Jason Hartman. Thanks so much for joining us today, and thank you so much for all of your business. I have to say, what a pleasant thing in today's economy. Business over here is booming. I mean, it is really booming. I think people are definitely sensing a bottom, and when I say bottom, this interview is actually going to distinguish what should be properly evaluated as a bottom. In many of the markets that we recommend, again, we don't think there is a bottom in the overall real estate market, because if you were to look at something like the Case-Shiller Index, which I would not recommend that you use that as your barometer, since we think that 16 of the 20 markets in the Case-Shiller Index are places you wouldn't want to be investing right now. But if you were to look at that, I think that we will actually see further declines in prices. But in the 19 other markets, 15 more, and 4 of the Case-Shiller markets we actually like. Boy, phenomenal opportunities, no question about it. And a bottom should be defined correctly, because on this show we're going to talk to Bruce Norris, who is a real estate prognosticator and expert. I think you'll find this interview to be really interesting. The bottom should be defined as the bottom in your overall effective cost of the property, not just the price of the property. See, a less informed person, a person who is not listening to the Creating Wealth Show, would think that the bottom price is the bottom. But the more informed person, like you listening, you understand that the effective price is how you evaluate the peak and the valley in the market and the best time to be investing. And so now when you can buy really inexpensively with the lowest rates on record, and I did say on record. No, I didn't say the lowest rates in the last 10 years or the last year or the last 5 years. I said the lowest interest rates on record. Just let that sink in for a moment, the fact that you can lock in at those low rates for the next 3 decades. It will be 2040 when these mortgages are being retired. So pretty incredible opportunity right now. When that inflation comes, and it will definitely come pretty severely in those 3 decades, probably several times, we'll probably have several big bouts of it, you will see that your inflation-induced debt destruction is a wonderful, wonderful thing. I'll have a couple announcements here before we get to the Bruce Norris interview, but one of them is, I've mentioned it before, be sure to join our text club. We've got a pretty good promotion coming up. I'm not going to tell you what the promotion is. It'll be a nice surprise, but join our text club by, from your cell phone, texting 411-24-7. Type my name, Jason, just my first name, and then your first name and your email address. Put a space in between each of those. We got some really good promotions coming up for text club members, and only for text club members. Also, join us on Twitter, and you can find us on Twitter at Jason Hartman ROI, like return on investment, or what is the other definition for ROI? Yes, that's right. It's not just return on investment, but it's also return on inflation. And that is where we talk about inflation-induced debt destruction, etc., which we've discussed on other shows, and we will discuss again, but not right now. And then on Facebook, facebook.com/Platinum Properties. You can find us there as well. So we've got some great content. It's all free, and it's there, so please join us there. The Creating Wealth event, we're pretty sure, like I mentioned on show number 180, that we're going to do that the day before this Masters weekend. Never did it that way before. We would love to get your feedback on this stuff. Go to jasonhartman.com/feedback and tell us what you think about anything. One of the things we want to hear about is, do you think we should have the Creating Wealth event right before the Masters weekend, the day before, the Friday before. And I kind of think we should. Remember, we've got another price increase coming up for Masters weekend. Get in now at the $847 price. We've got a preview call that is totally free coming up for that. I believe the date is September 23rd, and you can register for that at jasonhartman.com, and that is free. And also go ahead and get your tickets for Masters weekend as well. And I'll tell you, I am, as always, putting my money where my mouth is. I am buying properties right now. I'm buying 3 properties at the moment, actually. One is in Indianapolis. I love Indy because I am buying an income property bond there. And you know me, if you've been listening for a while, I don't like paying cash, but I have way too many mortgages, so they won't let me have any more mortgages on residential property. I can only do commercial mortgages from now on. So I am actually, for the first time, paying cash. Yes, you heard me right. Don't fall over. I hope you're sitting down. Jason Hartman is actually going to pay cash for a property. As much as I hate it, but it is such a great deal, I just can't pass it up. Here's what I'm buying. $55,000 single-family home in Indianapolis that returns a 20% cash-on-cash return, has a cap rate of over 16%, and a projected return on investment of 29%. You can't buy this one because I already bought it. Sorry about that. But I'm not telling you that to inspire envy or jealousy or anything like that. I'm saying, look, we have great properties like that for you. So contact our investment counselors through the website, jasonhartman.com, and we'll get these properties for you. Here's another one in Indy. And this one is $74,000. It's 2,000 square feet, and it was built in 2002. Again, these are not old, crummy houses. It's a good-looking house. It's on a nice-sized lot. 4-bedroom, 2.5 bath, plus a loft. Bank-owned property. There's about $13,000 in rehab costs for this property. So your total cash needed to buy this property based on 25% down, subject to qualifying, of course, $36,600 or so, and you'll be paying only $37 per square foot. You couldn't build it for that today. You couldn't even get close to rebuilding this house for that price today. So you're buying well below the cost of construction. Your projected rent here is $1,150 per month. And check this out. Your cash flow on this property, an income property bond, very safe, conservative investment, positive cash flow here of $388 per month based on a $35,600 investment. That includes your rehab costs, by the way, and you're putting $56 per month into principal reduction. So what do? We pull out our handy HP12C old-fashioned calculator that I and all us other old veterans in the real estate industry love, and your real cash flow per month is equivalent to $444 per month, essentially positive cash flow in that property. Your cap rate is 11.7%, and your total return on investment for this property is projected at 23% annually. You can't beat that, folks. These properties are just phenomenal. And by the way, to further put my money where my mouth is, if you need a partner on any of our properties, I am interested. Again, I can't do any more financing because I've got way too many mortgages, but I'll tell you, I am foaming at the mouth wanting to buy more properties right now. And so I'm buying 3 properties. I'm buying the one in Indianapolis I mentioned to you earlier. I'm buying a property in Atlanta right now, another one of our great markets, and I'm buying a property, an 8-unit apartment building in St. Robert, Missouri right now, and I'm partnering on that one with one of our listeners. So if you're interested in having an investor on any of these properties, you need someone to put up some of the cash. I have cash on the sidelines that I would really like to be putting into more properties. And if you're interested in having an investor, I am an investor and I would love to go in on this. Here's another property, and this is in Anna, Texas, a suburb of Dallas. This property was built in 2004. The price is $129,500, and your total cash needed is $38,850. Projected rent $1,295 per month. Positive cash flow projected at $156 per month, plus another $114 in principal reduction. Let's add those up on our handy HP12C here. I was taught to never do anything in my head, by the way. I was always taught to use the calculator. So $270 per month effective cash flow in that property. Your projected return on investment here is 22% annually, and that's in the Big D, Dallas. slightly more expensive market than Indy there, but fantastic. So you should be buying properties right now like they are going out of style because these deals are phenomenal. I don't think you should be doing that in California yet, as our next guest does. But I really respect Bruce Norris because he's got a lot of phenomenal information. He's pretty California-centric, but hey, to each his own. It's in his own backyard, and he likes it, and he's comfortable with it. And he has done business in other states, and I think you'll find this interview to be very interesting. Before we go to that, I just want to talk to you a little bit about an ongoing theme of our last few shows, and that is the theme of managing your own properties, the theme of self-management. And I tell you, I am becoming more and more interested in this every day. As some of my property management agreements come up for renewal, I am going to be letting my managers go. Now, as I said before, this is not for everybody, but I'm finding it to be a very pleasant experience. And I was talking to Ari, one of our investment counselors, today about this at lunch, and as we walked over to lunch from our office here, and one of our other clients happened to just walk by, and I said, "Hey, Patrick, sit down with us for a few minutes." And we started to talk about this self-management opportunity. And if you have a problem, you can hire a property manager at any time. And what I said to Patrick and Ari, I have this local property that I've owned here, right here in Orange County, and I've rented that property for a little over 5 years now. Now, to be very frank, I wish I had sold it at the peak of the market, but I was busy with other things. I was buying a lot of properties nationally and just kind of never got around to selling it. I had a stable tenant, so it sort of wasn't on my mind. So I kept it, and of course the value has declined a little bit, but the rents have held nicely steady regardless of the values. And I re-rented that property probably about, I'm going to say maybe 3.5 years ago, and I have not been there since. I have not been to that property in 3.5 years. I don't have a manager for that one. The check comes in every month, just like clockwork. I've had the same tenant. My San Antonio, Texas property, where the manager got out of the business I told you about before, that's probably been, I think now, 15 months. And I've never seen that property in my life. The check comes, everything's fine. I've had maybe a couple of emails back and forth with the tenant, one phone call, and it's going great. If I have a problem tomorrow, I'll just hire a manager, or I'll hire a handyman, or if there's a repair, I'll just tell the tenant to get 3 quotes and fax me the estimates, and I'll approve one. I'm just thinking it's not for everybody, but it's for me. I'm going to start doing more and more of my own property management. So for whatever it's worth, those are my thoughts. I'll keep you up to date on my progress there. But if I can save $1,500 per year per property on average, and I don't get nickel and dimed for this or for that, hey, more power to me. I think it's going to be great. I've got a lot of travel coming up. I'm going to be visiting a lot of our current markets in the month of September and some potential new markets, so I'll update you on those on future shows. But let's get to Bruce Norris here, and let's hear what he thinks about the market. We're going to be talking mostly about California, but a little bit about the national picture as well, and I think you'll really like this show. Again, Bruce is a great guy. He does a great job, and we will be right here with that interview in less than 60 seconds after this brief message.
Hey, Al Rantel here. You know, with all the financial uncertainty, now is the time more than ever to be in touch with Jason Hartman. They have what's coming up we call the Masters Weekend. Now, they're going to learn about the tried and true conservative investments that work in real life. For example, how to get the taxes back that you paid over the last 5 years. Imagine that. How to make up to 40% or more, even in today's climate. How do you reserve? How do you find out information? Simple. Go online to jasonhartman.com. Also, get your free educational podcasts. Do not miss the Masters Weekend.
It is my pleasure to welcome back to the show Bruce Norris. He is president of the Norris Group, and you've probably heard of Bruce. He is quite a well-known guru in the industry. He makes predictions that happen to come true, and I'm just glad to have him back on the show. He was on the show a long, long time ago. And Bruce, welcome back.
Jason, thanks for having me.
Tell us what you see going on out there in maybe we'll start with the broader economy, the national picture, and then look at some specific markets, specifically California.
Well, as far as the real estate market, what you're seeing in most areas that have had problems is you're seeing low inventory, which is actually creating price support. So I'll go to California, which is specifically the area that we deal in, and I'll just tell you that it appears that the real estate market is improving, that it's firming up, inventory is down, and the problem is it's completely a controlled market, and I feel that any government policy change could change the direction of that. The bigger economy has problems in that you have unemployment at a very high level and lasting for a very long time. So unemployment benefits, which typically are extended for about a half of a year, I believe have just passed to where they're now good for 2 years. You wouldn't pass that if you didn't have a vision that this is going to be a problem for quite a while. So that has a direct impact on the ability for people to make house payments, for them to qualify for loan modifications, for them to qualify to repurchase a house. So there's the big picture economy definitely is having a negative impact on real estate.
No question about it. Bruce, when you talk about California, I know that you are a private lender, you do hard money lending, and I think that is becoming a much safer bet than it was because, of course, the loan-to-value ratios have been, maybe they've stayed the same, but the prices have been adjusted, so a lot of the froth and the fluff is out of them. The big thing that concerns me about California specifically is the state's budget issue, and just looking at it, at this state that seems like it can never fix itself with the entrenched iron triangles, the unions, the government. They're all they've set up these triangles where you sort of can't seem to ever control the expenses of the state. What are your thoughts on that?
I think that California is definitely one of the problem areas in the short term. They're definitely going to have a negative budget. They're going to have to probably inform some unions that the promises maybe won't be kept. So they almost have a Social Security issue. Social Security probably isn't going to be able to make all the payments it promised to everybody. And I think there's going to be a lot of people in California, maybe state employees, city employees, they're going to find out that their defined benefit plans really don't have the money that they're supposed to. So I think that's going to have to be confessed and dealt with. But on the other side, you have an awful lot of venture capital very interested in California, and that's because the history of California is we are resilient. We're a very desirable place to be, and so what will probably end up happening, and it already has in the real estate market, is we'll skew to too low of a price. So the real estate that we're buying right now, you couldn't build for the cost that we're buying it at. So we're buying below-cost real estate, and in a market that very few people really aggressively want it. And that's not usually how California stays for years on end. And this is going to be the longest downturn that we'll probably experience, and certainly the hardest one. But it'll come to an end someday, and somebody's going to build another house in California. And I would say the people that invest in trust deeds or in real estate in California will be rewarded for what I really consider very minimal risk at this point for the upside.
And when you address California, really the area you like is the Inland Empire, maybe specifically Riverside, right?
Just happens to be where I live.
But that's the area that you think it makes sense. You wouldn't touch some of the coastal areas or the more expensive areas in, say, Orange County or LA counties or San Diego?
No, I would. But it's just a different play, if you will. If I'm in Riverside, I have the luxury of having a cash flow property more likely than any place in Orange County. But I'm pretty familiar with the history of how prices come back, and they usually come back from the coastal areas inland. So I would certainly feel fairly comfortable at some point buying property that is a coastal purchase, even if it had a slight negative cash flow, because I know that the inflation of that property would probably be earlier and quicker than anything else I own in Riverside. So it would be a different play, that's all. So coastal real estate, I just think you'd have to be cautious and make sure you could survive any of the cash flow issues until it went up. And it may be too early to do that. So Riverside and San Bernardino counties in decent areas definitely has more of attraction to an investor.
And in terms of timing, Bruce, this is a cycle, and we've gone through cycles before, obviously. I've seen 3 of them in my career. What are your thoughts and predictions on the timing of the cycle?
This one is the most difficult to time because the statistics that I normally rely on are being played with a little bit by the powers that be. So you have, for instance, you have very high delinquencies. You have people not making house payments, record numbers, and yet you have foreclosures declining. That's a mathematical impossibility unless somebody is playing with the numbers or playing with the idea that we don't have to foreclose on people that aren't making their payment. And that's kind of what's going on right now. You have lenders that are not receiving payments and are willing to continue not receiving payments for quite a length of time because it looks like it might be in their best interest not to take the house back and realize the loss that would occur. So that's what makes it hard to do predicting in this market is you're really looking at, in my history at least since I would say the early 70s, that a market is allowed to get people that are behind in payments are allowed to stay there, and the lenders are encouraging every other solution other than taking the property back and reselling it.
It sort of strikes me interesting when we look at what's going on with loan mods out there, and it seems like B of A has finally sort of gotten their act together, and they're really starting to modify loans now. But one of the things that concerns me about these loan mods is that it seems like we might just be kicking the can down the road because they're not doing, as far as I can see, very many principal reduction loan mods. And they're doing usually a 5-year type of scenario where they'll cut interest rates in half. But like you said in your Tip of the Iceberg talk, if someone's payments are affordable, but their equity is upside down dramatically, even a quote-unquote good citizen will just tend to walk away or stop paying, right?
Those percentages are getting higher, and I think that has to do with society accepting that that's a reasonable decision. So the more people do it, the more permission there is for someone that heretofore would not have. They join the party and say, well, my neighbor's doing it, my cousin's doing it, and everyone thinks I'm nuts for not doing it. That pressure does get to people, and all of a sudden they decide, well, yeah, this is kind of silly. I'm making a payment on a house that's upside down. And they rationalize walking away. So it kind of feeds itself, and that's one of the reasons why these lenders have to be very careful about giving principal reductions. I guarantee you the word would get out if everyone started giving principal reductions. And so then you'd be very hard-pressed if you were making your payment and your neighbor got a discount for not making his, of $250,000, you'd wonder, okay, now why in the world am I making my payment? Because you're getting bonused for not making one. And that's their dilemma. I think they know that the loan might ultimately be foreclosed on, and they are, in fact, kicking the can down the road to a market that they're trying to think will be perhaps more bearable than the current situation. It's a very dangerous game, to be honest with you.
Yeah, it is. There's certainly a big moral question to that, a moral hazard. Your last, I believe it was your last product, and I think it was your last big talk also, was entitled The Tip of the Iceberg. And the connotation of that to me is that, look, we've still got a lot of problems ahead. There's a lot of stuff under the water that hasn't surfaced that maybe many people aren't seeing, right? Is that title in sync with what I'm thinking? A lot of bad news coming?
A lot of bad news potentially should have shown up and didn't, and that's what's lurking underneath the surface. When you have delinquencies, Riverside County, I'll be specific, there's a company called Finch that has reports that they produce, and they came out and said that in Riverside, something like 47% of the owners that have subprime or Alt-A loans in Riverside County are not making their payments. That's unbelievable. And yet, if you look at the foreclosure chart, it's gone down from a year ago. So at some point, you have to think that we're going to have to actually foreclose on those homes or do a loan mod or get a deed in lieu. But there's going to be an awful lot of real estate exchange hands in Riverside, San Bernardino counties especially. I think the Tip of the Iceberg was also saying that we're not being very honest about our state situation and people's retirement, and also our federal government promising all the things that we have when mathematically it just is impossible to keep. And so it's a hard report to write because what it was basically saying is that we have to get honest about the situation in the next few years, or we're really going to face a very difficult future because if we wait too long, the numbers just get a little bit out of control and become not as solvable. I'll put it nicely.
You seem to be saying that, at least in Riverside, the market has stabilized to an extent. But how much do you think, Bruce, that the tax credit that recently expired has manipulated the market and potentially, at least when it was in effect, kind of puffed things up to make them seem better than they actually were?
Absolutely, that has been a problem, and this is not just happening by a federal tax credit, it also happened with the loan policies that they had in place, let's say through 2005, 6, and 7, is that we basically are borrowing from the future buyers that wouldn't have been mature enough to qualify or have enough money as a down payment, we're so desperate for volume that we keep on figuring a way out how to shove somebody into ownership earlier than they should probably get there. Well, at some point you just run out of enough people to get in, and I think we're there. How would you qualify, when you think about, I've heard these terms where we have pent-up demand on the sidelines to buy real estate, and I really disagree with that. When you have the highest unemployment that you've had since the Great Depression, and you have the highest delinquency rate since the Great Depression, and you have a exiting of people, negative migration from the state of California, and you have a lot of owners upside down, who would be the new buyer that's going to show up in droves to buy all this inventory?
Thank you for listening to the Creating Wealth Show. This is Jason Hartman, your host, and we appreciate you following the show. We have many, many episodes, hundreds of episodes, and some of the older episodes have been archived and placed in our members section, and that applies to this one. So we include a sample that's about 25 minutes long, and then for the rest of the show, you can go to our members section at jasonhartman.com. Many of the other shows are still in their full-length, complete version. However, some of the shows, like this one, are in our members section where you can hear the show in its entirety. And again, you just need to go to jasonhartman.com and you can get the full show there in the members section, plus a whole bunch of other great members benefits and resources, whether it be documents, forms, contracts, articles, other video and audio content. Just a great resource. So be sure to join as a member at jasonhartman.com. And thanks again for listening to the Creating Wealth Show.
This show is produced by the Hartman Media Company, all rights reserved. For distribution or publication rights and media interviews, please visit www.hartmanmedia.com or email media@hartmanmedia.com. Nothing on this show should be considered specific personal or professional advice. Please consult an appropriate tax, legal, real estate, or business professional for individualized advice. Opinions of guests are their own, and the host is acting on behalf of Platinum Properties Investor Network, Inc. exclusively.